Assalamualaikum and hi everyone, welcome back to my channel. In this presentation I'm going to show you the consolidation adjustment for intra-group sale of depreciable asset, with our focus today on using the depreciation method reducing balanced. In my earlier video I have already discussed on the straight line method. You can check that in the video that I have already published, which is under illustration 1. For your information, intra-group sale of asset falls under the intercompany transaction, and all intra-company transaction that relates to unrealized profits that may or must be eliminated. So this is what we're going to do. We're not just going to eliminate the profit that was earlier being recognized. We are going to eliminate that profit and we are going to make provision for unrealized profit. At the same time, because this is related to intra-group sale or intercompany disposal of depreciable asset, we also need to make adjustment for depreciation. So for your information, this example is just focusing on the intra-group sale of depreciable asset that will have B where it relates to the parent and subsidiary. Subsidiary is the seller, and in C is the parent, that is the seller. So let's just look at the information that you have in this question. So you have the information. The first information that you should take note is when is the date of acquisition, as well as when is the reporting date. So the date of the statement of financial position given is normally your current financial year end. You will normally be asked to prepare the consolidated statement of financial position or consolidated financial statement on this date. This is your reporting date. And you have the information given here that you invested in the company called Sugawara. So Sugawara is the subsidiary company and Hinata is the holding or the parent company. And what you invested is 240,000 out of the 300,000 shares. Since you are not informed, you assume the fair value is 1 ringgit. So I'm taking the units. So that will give you 80%. So that was the acquisition in terms of the one that gives the control. That happened on 1st of January, year 3. And this is the date of acquisition, or the acquisition date here is given together with the information on the pre-acquisition reserve in the subsidiary. Okay. The first information here that you have is about the intercompany sale of non-depreciable of a depreciable asset. And here Sugawara, as we know, this is the subsidiary. It sold the plant and machinery to Hinata. So Hinata is the parent. So you need to go and just find out who is the subsidiary. So it is the subsidiary here is the seller, and the parent company or the holding company is the buyer. If you have watched my video, you would notice that we have to find out what is the unrealized profit and what are the depreciation of the subsidiary that has been over provided, right? And that depreciation that has been over provided by subsidiary has to be adjusted in the retained profit of the by the buyer here. Buyer here is the parent company. So the one that has been over provided by the buyer has to be adjusted in the seller's retained profit. So that is what you need to do. So the first thing is to find out what is the unrealized profit. Second is to adjust the depreciation. To find the unrealized profit, you need to look at the information. The date of disposal here is given, which is on 1st of January to year 2. So the date of disposal is 1st of January year 2, meaning to say that that is where the intercompany transaction took place, right? And you are informed that there was a machinery being sold for 50,000. So you need to go and find out what is the selling price, 50, and compare that with the carrying value, which took place on the date of disposal. So that is what you need to do. And find out the correct carrying value. In this question, it was directly given to be 30,000. So you can see that there was a profit of 20,000, and from there you'll be able to calculate the depreciation being over provided, and you can do the consolidation adjustment for both unrealized profit and depreciation that was being over provided. The second thing that you need to do is, if you have another transaction like in this case here, is to look at the second part C here, where you have another situation that the subsidiary is no longer the seller, but is the parent that is the seller. So the parent is the seller. Parent is the seller. So you need to do the same thing that you have done. Sorry about that. The same thing, and only that now another asset that is building that is being sold off to the subsidiary. So subsidiary is the buyer. So again, you need to adjust for the unrealized profit and the depreciation that has been over provided. But bear in mind, now the subsidiary is no longer the seller, it is the parent. So you need to go and adjust the retained profit of the seller, which is the parent company. So the same thing, you need to go and find out what is the selling price as well as the carrying value. All information is available here. If you look, the selling price for that building was 150,000. And you are given the cost and accumulated depreciation for that particular building, where the cost was 180, right? On the date it was disposed, and 80,000 is the accumulated depreciation. So if you have noticed that 100,000, which is the difference between 180 minus 80, which you have 100, is actually the carrying value. And you can easily calculate as well what is the profit, right? So from there, you will work out what is the over provision of the depreciation. So for this company, they are using 5% for the percentage or the rate of depreciation for the building, and 10%, which is the rate of depreciation for the plant and machinery. And both are using yearly basis, right? So you have the information there in D confirming that yearly basis is being used. You are going to prepare actually the statement of financial position, the consolidated statement of financial position. Before you can do that, you need to go and do the consolidation adjustment relating to this item. You normally will have more item, but our focus today is more on the intercompany sale of depreciable asset. Okay. Right, that is the question. And let's look at how do we work that out. Okay. You can see next to that question, I've already prepared answer for you, right? Where this issue again is on the intercompany sale of depreciable asset, and we are doing two things to eliminate the unrealized profit, to eliminate also the over provision of depreciation, and then again we are going to prepare those requirements, which is to calculate goodwill where necessary, and then do the analysis of financial statement using the schedule approach, where we are going to do that later. But before that, okay, for our unrealized profit, we have already calculated earlier. If you can still recall, we have calculated much earlier here, right? This difference between 52 and 30,000. So the selling price on the date of disposal, I've already informed, that was on 1st of April. So we just make some amendment here. because that was not 1st of April. It should be 1st of April. Sorry, it was 1st of January actually. 1st of January, right. 1st of January, year 3. The 1st of April is for the second asset. 50 minus carrying value, you have 200,000. You can straight away do the workings there, make it very quickly. So 20,000 is what you debit to the retained profit and the retained profit of the seller, and that 20,000 is what you credit to the plant and machinery. And this will give impact, this one, it will give impact to the calculation of the group reserve, where you will see that 50,000 will appear under the retained profit of the subsidiary, because this subsidiary is the seller, right? And the same thing will also appear in the consolidated statement of financial position, but I'm going to show that later. Now we're going to do the adjustment for depreciation. So if you look at the depreciation for plant and machinery, right? So that the depreciation adjustment that we need to do is from the date of disposal, until the current financial year end. That means from 1st of January year 2 up till the current financial year end, 31st of December year 3. So that was for 2 years. So year 2 and year 3. So this is the first year, and this is the second year to the point of view of the buyer. So in the first year, the buyer will charge based on the price that were purchased, 50,000, even though that was a straight reducing balance method, because that is charged on cost. Second year, it will be based on the carrying value, which is 50,000 minus 5. So for that 2 years, depreciation have been over provided by buyer. That was the depreciation that has been charged by buyer was 9,005. Okay, that was the case of buyer here, Hinata, which is the parent company. To the seller, which will be the depreciation to the point of view of the group, depreciation is still being provided based on the carrying value. So the carrying value is 30,000. So they are providing depreciation maybe for the third year, of I'm not sure for which year, but it has been on the carrying value, the 3,000. For the third year, it will be provided also on carrying value, which is 30,000 carrying value minus 3,000 the accumulated depreciation. So you have 7,000 here. So you have 2,007 because the rate is 10%. So you have 5,007. So you can see that they were different in depreciation charge by both parties, and the depreciation was being over provided by the buyer, the holding company, 3,008. That is one way of doing the calculation. It is a long way. A shortcut method that you can do here is by taking, you can only do this if this is reducing balance method, is by taking the figure here. Just take the URP, right, 20,000. Take the URP. For the first year, you take 10% times 20,000. That will give you 2,000. For the second year, you will take, so it will be here 2,000 plus 1,800. That will give you 3,008. For the first year, it is 10% from the unrealized profit, 20,000. And for the second year, it will be 10% from 18,000. Why 18,000? Because 20,000 minus this 2,000 depreciation. So it will give you 18,000. So 18,000 times 10%, you get 1,008. So if you total up that figure, that will still give you the same amount of 3,800. So the choice is yours. Whichever you want to take, it should give you the same answer, right? The same 3,008. So now go and adjust the over provision, reduce the retained profit of the seller with the depreciation over provided by the buyer. So if you reduce for the plant and machinery, it is provided at carrying value. So go and adjust to the plant and machinery account of the buyer. How much? 3,008 for the 2 years that have been over provided. Remember the difference in depreciation, that is what we are looking for. So that will later be shown in the retained profits, right? It will be shown in the retained profits of the seller in the schedule, right? Next, the next one is for the situation C, additional information C, where you have the seller now is the parent. So building is the one in our focus. The buyer is the subsidiary. So the same thing, selling price, we have worked out here, 150. The carrying value, we have already worked out here, 100. Unrealized profit will then be 50. So to the point of view of the seller, go and adjust in the seller's retained profit, where that was the group or consolidated retained profits, which is the one of the parent company now. 50,000, remove that unrealized profit. You eliminate that because that will not be reported in the consolidated financial statement. So you will go and credit to the asset involved, land and buildings of the buyer. So 50,000. Then you will do again the adjustment for depreciation, right? So this depreciation adjustment that you need to do is just for 1 year. Why? Because the date of disposal was in the same, was on 1st of April, year 3. So you just need to do depreciation for 1 year. That is the case of yearly basis, regardless how long is the asset with you. It is less than a year, right? But because you use yearly basis, you will still charge full year depreciation. So depreciation that was being provided by the buyer is based on the price being purchased or the selling price to the point of view of the seller, but that was the purchase price to the point of view of the buyer. So 5% times 150 only for 1 year, because the transaction took place in the current period. If that took place in the earlier years, you may have to do something like this. And depreciation by the seller, they will still depreciate based on the carrying value. The carrying value is 100,000. So 100,000 times 10%, 5,000 for just 1 year. So the depreciation that has been over provided by the buyer, that is the subsidiary company, is 2,005. You can also do the same method of doing the calculation for depreciation being over provided, as I show here, by taking the unrealized profit and multiplied by the percentage of the rate of 5% here. So 2,005, because this is just for 1 year. And you will be doing the adjustment here. So the adjustment that you will be doing is looking at the over provision, and the over provision is to the point of view of the buyer, and we are adjusting that in the seller's retained profit. And our seller here is the holding company or the parent company. So that will be adjusted. The accumulated depreciation account will be adjusted, because you do not just have only the carrying value, but you also have the cost of the building. So you should adjust that in the accumulated depreciation where you have that information. Should you have no information regarding accumulated depreciation, you can adjust directly in the building account, assuming the building is at carrying value. So that is adjusted to the accumulated depreciation of the building to reduce the depreciation that has been over provided. And that will be adjusted in the retained profit of the seller. Here is the parent, the group profit, 2005. Done. So what we will do now is we are going to look at the impact of that. So you can do the calculation of goodwill by using your knowledge that you have learned earlier. that you take the consideration transferred, this 400,000, which is, I will change the color, wait. Okay, this to 400,000, take this and find out the non-controlling interest. Here nothing is informed, you assume it is measured based on the fair value of the net asset. Ordinary share capital is the one here. Retained profit pre-acquisition is this 60,000 given here, right? 60,000 pre-acquisition profit, and this is the share capital that has been eliminated. So goodwill will be 112, no impairment so far. So now we look at the impact of our consolidation journal that we have done. Number 1, number 2, number 3, number 4. Just transfer that to the correct column. For the one that is done in Sugawara, transfer that to the retained profit of the subsidiary. Unrealized profit is deducted. Old provision is being added. Why? Based on the journal that we have done here. Number 1 and number 2. Okay. Right. That is consolidation journal entry number 1 and number 2. Then, where do you adjust that? It should be after you have put the balance as per the statement of financial position. This one is the one here. The pre-acquisition balance is this 60, and this is your so-called post-acquisition unadjusted balance. And this figure here is the adjusted post-acquisition balance. You adjust for the consolidation adjustment that need to be done. So you have 83,800, the one of the subsidiary. The parent will have a share of 80%. You can see the formula that I use here, 0.8, which is 80% based on this 80%. And the subsidiary's profit is shared by the parent as well as the non-controlling interest. They have a share of 20%. So for Hinata, the parent, you will have to also do adjustment relating to unrealized profit on the sale of land and building. So you can see that I put here CJE 3, CJE 4, which refers to our adjustment that we have done much earlier. So I will just make it bigger for you, right? So that you can see better. Okay, right? So you have 3 and 4. So that should be shown in the information here. Over provision of land and building. Okay. I just put the color. Easier for you to see that. And the unrealized profit is this. Okay, that was in the light green color. Okay, that was the one that you have here. That is from Consolidation Journal Entry 3 and 4. If you can do it straight away here, that is even faster. And you have the over provision. So now you can find out what is the group retained profit, because this is the figure that you will bring forward to the soft P, or this is the one that will go to the consolidated statement of financial position. The one that will go there is this, and also the non-controlling interest. Remember, on the date of acquisition, the NCI was 72 because it is 20% from the fair value of the net asset on the date of acquisition, 1st of January, year 1. Right. So now you can go and prepare your consolidated statement of financial position, focusing on the non-current asset. Remember to go and add the one which is to combine. This is to combine the one of the parent, that is to combine in that bracket. And the part that is outside the bracket is to do the elimination. So this is to eliminate what? The unrealized profit. So eliminate means to remove. The one in the parent and subsidiary will be added because consolidation will combine asset, liabilities, right? All right, now accumulated depreciation also the same. The one that is being combined is the one of the parent, but the accumulated depreciation will remove the over provided depreciation because this is to remove the depreciation, so you need to go and reduce it, and this is also another elimination minus the elimination. If you are already good enough, you don't have to write all this working. Right, this is for learning purpose. So 275,500. For the plant and machinery, all adjustment will be done in the plant and machinery since that is at the carrying value. Okay, the plant and machinery is at the carrying value. So therefore, you are going to add the 200,000 of the parent with the one of the subsidiary, and there will be two elimination. The two elimination is to eliminate URP. If you do this in consolidation worksheet, you will be doing that in column. But this is for exam purpose. You're not doing the worksheet. And you are also going to eliminate the depreciation by adding it back to the plant and machinery. So that will give you the depreciation that is being over provided to be 3,008. So you have 323,800. The goodwill is directly here because no impairment. If there is impairment, you need to go and charge the impairment loss somewhere here. And you have the ordinary shares that should just be of the parent. Unless parent also issue bonus shares, you may have to add the bonus share to the parents' balances here. The group retained profit is from here. The non-controlling interest is from here. With that, our focus, remember, is here, right? Our focus is on the consolidation adjustment for the intra-group sale of asset. With that, I thank you for watching. If you think this video will benefit others as much as it benefits you, kindly share them, and that will make things go faster and help others too. With that, I thank you for watching. I'll see you when I will see you. Assalamualaikum, and have a nice and pleasant day ahead.